Here we go.
Joins us now in an exclusive interview. Cathie, good afternoon. Thanks so much for joining us.
Happy to be here, Wilfred. Thank you.
Let's touch, if we may, on this sort of current pullback. Do you actually welcome that as a long-term buying opportunity for a lot of the stocks you love, or are you feeling the heat a little bit?
Oh, I love this setup. The last time I was on, I think I said that this rotation was good news because it meant the bull market was broadening out. It was strengthening. And the worst thing that could have happened to us is to have the market narrowly focus on just our ilk of stock, the innovation space. Instead, it has broadened out so that year to date, I think it's energy's up 40%, financials are up 27%. And from the peak, in mid-February, our strategies are down. The ones that have been hit the hardest, not all of them, are down 30 to 35%. I love that setup. From our point of view, 5-year time horizon, nothing has changed except the price, and therefore the return, which at the peak of the market and of our strategy in mid-February, we expected a compound annual rate of return of 15% on average per year from our strategies. Now that the prices are down,
25%.
That number is somewhere in the 25 to 30% range.
To 30, she raised it.
You may love the setup, Cathie, but it hasn't been great for your business. I mean, worst start to the month on record. You've seen outflows of $1 billion. How are you managing these declines? And there's speculation out there that if the outflows continue, it would be hard to meet redemptions.
Oh, Sarah.
No, well, first of all, I don't have to worry about redemptions. ETFs, the ETF ecosystem is a beautiful thing for portfolio managers. I highly recommend it. So what that means is when I am making decisions, they are investment decisions. I have nothing to do with the flows. The ETF ecosystem, the authorized participants, the market makers outside of ARC, although of course we're overseeing their actions, they are facilitating our flows. And they're doing it in many ways with algorithms and derivatives. I think the ecosystem has become quite profitable for them. So we have experienced no problem. If you look at our spreads, there's been hardly a disturbance in our spreads. As far as flows, actually, we've been very gratified. I think if you go month by month now, this is endpoint to endpoint, we have not seen a month of redemptions yet. I would be... I don't want to say never. I mean, of course, we're going to get redemptions. And in fact, in the ETF structure, when we get redemptions, because of the in-kind nature of redemptions, we are able to offer a much more tax-efficient strategy or portfolio in this wrapper than we ever could have in a mutual fund.
Cathie, I wanted to dive into a couple of some of the talking points people have put out in the last couple of months. And the first one is what you would say to those people that have criticized the way in which you've held your own ETFs within one of your other ETFs. Do you accept that in the least that's not an ideal...
The 3D print ETF is in the Space ETF.
This is the 3D printing fund within the Space ETF, ARKX.
Nailed it!
Because 3D printing is one of the killer apps, in fact, the killer app, is aerospace, including space. We felt it very important to have a good smattering of 3D printing. Now, 3D printing is a smaller cap space. And so we felt that because it was so important that we would put it in our fund. However, our clients are not being
double
charged. That comes out. We do not charge them double fee.
There you go.
Instead, they have a very well-diversified participation in 3D printing, which I think as more and more people understand how important it is going to be to aerospace, not just rockets and satellites, but also airplanes, including the engines. I think they'll appreciate why we own 3D printing and wanted to own it in size.
Whether it's the 3D
It doesn't look good.
ETF within the Space Exploration and Innovation ETF, or a couple of the other holdings in that Space Exploration ETF, like Netflix, like Deere, should that ETF be called just the Innovation ETF? I mean, is the Space Exploration part of it at the front of its title, the lead part of its title, a little bit misleading?
What's balancing, bro?
No, not at all. In fact, what we believe, and comparing and contrasting to the other offerings out there, which have satellite radio, satellite TV, the old world, we believe the next frontier here, where there are real money-making opportunities, is not space tourism. It's going to be a very small market in the short term. It's two markets. Mobile connectivity. There are 3 billion people around the world who have no access to Netflix, broadband, and the internet.
Nice.
And the satellites that SpaceX and others are putting up there now are going to give those people an opportunity to become a part of the Netflix family. So we think Netflix is going to be a beneficiary. Deere is probably, because of its name and everybody knows its tractors, they think it's old world, old DNA. They, for a more industrial company, they're one of the most progressive companies I've seen embracing technologies. Now, farming is going to become much more efficient. The productivity gains are going to be enormous as we start using drones to identify exactly how much fertilizer is needed, where. So I think that drones and some of the connectivity from a weather point of view, they've done for years. They bought a company from Monsanto to focus on the weather and how weather patterns would affect farmer productivity around the world. So I think autonomous farming is going to demand drones, satellite information, and so we think it's going to be a big play.
I guess the other factor I'd just throw in as well, that you remove limits on investing more than 30% of assets in a single firm and more than 20% of a single firm's shares, as well as some of those other factors that we mentioned. And I guess just bring it all together, the broad question I had is whether, because of your fantastic inflows, it's a great problem to have, whether you grew a bit too fast for your investment universe, for your ilk of stock, as I think you said earlier in the interview, and whether at any point over that period, the last 6 months or so, you did pause and consider thinking, maybe we should stop allowing more inflows and close the ETFs, close the funds, rather than launching more ETFs, raising limits, buying your own ETFs within your own ETFs, and whether that was a question you at least asked yourselves over this massive inflows.
Why is he doing that?
Well, it's not possible to close an ETF, unlike a mutual fund. So that's
it's not impossible, though. I mean, you can change the rules of the game somewhat.
I do not think it's possible. I think the regulators would have a big problem with that, the way they've set the structure up, especially because of the way ETF flows are handled. Really, that's not within one firm like ours. There's a whole ecosystem around us. We went from 10 billion to 80 billion in 10, 11 months. Right. That was pretty parabolic. And of course, we were very grateful for those flows, and we're still grateful for the flows we are getting. But that's parabolic. We are used to exponential growth. That's what we do. Our strategies, our innovation platforms, we believe are going to scale exponentially, and therefore our capacity should scale exponentially. 10 to 80 billion was a little faster than that, and so we've taken risk control measures so that we do not own too much of one stock. And you'll also see we've seen an explosion of IPOs around innovation, secondaries, SPACs are all about innovation. So we are getting more and more opportunities to scale with these newer companies participating in the innovation space.
Nice.
Cathie, I wanted to talk Tesla, one of your favorite stocks, because that's part of the performance issue. It's off 25% from the highs. And there's some real questions right now about the reliance on autopilot and whether that has led to some deaths. You have been super bullish on Tesla's autonomous future and the vision of robo-taxis. Isn't that problematic, given some of the concerns here around safety?
Nope.
Actually, I think we've gotten some very important information recently that Tesla is seeing its way through, so to speak, to autonomous. And that is, they've decided to take radar out of the ecosystem and just depend on vision, computer vision, CV, so 8 cameras. I think they're getting much closer. And, as far as autonomous, when anyone talks about safety in an autonomous vehicle, they have to consider the alternative. The alternative is human-driven travel. Humans are responsible for 80% plus of all fatalities in automobiles. And so autonomous is going to really take that issue away from us. So we think that we're much closer than most do. We think we're probably not as close as Tesla thinks it is. But we do think within the next 2 years, we're going to see some really surprising breakthroughs from Tesla. We've been watching Waymo and Cruise Automation here, and we think they're probably struggling with how to scale that business. We think Tesla is going to go autonomous at scale or much more quickly than any of its competitors.
Wow.
And then there's the China issue. They seem to be really clashing with customers on social media, the public, and the government. What do you think is going on there, and how much of a risk factor is that for the stock and the business?
Well, we do think that that China wants its locals to win. We saw, I think just in this week, NIO, because of the battery swap system it has, no matter what it's pricing its cars at, it's going to get subsidies, whereas the Model Y will not get subsidies in China. So there is some favoritism for locals, but we found something out very interesting this week. If you look at the drop in share of Tesla's cars in the electric vehicle space in China, what you will also see is an increase in the number of exports to Europe. And in talking to the company, we found it curious. And it seems that the quality of cars being built in China, in that super modern factory, the quality is much higher than those being built in Fremont. And we know that the European customer used to beautiful German cars is very particular about quality and design. Yep. And we think Texas will be a step up as well. So Fremont's just a very old plant. So it was very interesting to learn that. And so I think that Tesla will manage the issue you've identified and that many are discussing by exporting to the rest of the world. And I think China's going to like that. China has not been a big exporter of autos to the developed world. This will be a feather in their cap.
Interesting theory. Cathie, we have a lot more to talk about with you, a lot more names to get to. So please stay with us if you would. We're going to take a quick commercial break here on Closing Bell. More with Cathie Wood and some of...
Good. Okay, they're going to keep talking to Cathie. This is great. Honestly, this has been wonderful so far. I mean, I'm just going to give a quick summary here, then we'll see how much of this we can hit during their commercial. But I love that she's talking about how this rotation is good. I mean, this is what we've been talking about day in, day out on this channel, is that, folks, stick with the high quality. Buy the high quality stuff. Short-term pain equals long-term exponential growth. That's what she's talking about. And she's even revised up her expectations. She used to say, oh, well, we think returns are now from, instead of being 15% a year over the next 5 years, we think we're going to be at 25% a year. She's revised that up. And now she's saying, well, we think now returns are going to be 25 to 30% per year after year after year for the next 5 years on the high quality companies they invest in. Those are companies like Peloton, Square, Roku, Tesla. Folks, these are the high quality companies that, yeah, they've sold off, but Cathie's doubling down on. She's playing a lot of defense here, but going with aggressive D, I would say, because CNBC's they're trying to attack her and do these like subtle slams on her, especially with, having an ETF within your own ETF. Cathie did very well to clarify we don't double charge our customers. We just think it's good to have 3D printers in with the space fund. Great clarification. CNBC still comes out and slams her. We got to get Cathie on the channel, okay? That's what we need, is Cathie on here. But anyway, we've got, we'll tweet her. That's what we'll do. At RealMeKevin. I'll send a tweet in a moment. But she mentions, look, there are so many tremendous opportunities that we're seeing because of these prices coming down, and defends why you want Netflix and John Deere, these very forward-thinking companies in the space fund ETF, because you're going to get so much more satellite connectivity that's going to help with not only Netflix access, but also drone access. Very interesting point of view, but you also get the balance with that. Of course, they've had parabolic growth over the last 10 to 11 months, growing the fund from 10 billion to 80 billion. We've seen the outflows been a little bit more severe. Anything under this line here, where my mouse here is, are outflows. And so, yeah, we've seen more outflows than we have at any point previously here, but that is because the market's been a little, poopy-doopy in certain sectors. I love her talk here on Tesla, that, look, Tesla's in for some big surprising innovations in the next couple months. And something that she really mentioned that really hit home for me, especially here in California, is that Chinese-made Teslas are actually higher quality. And she didn't say this part, but I know this part. The Teslas in China, they're higher margin. So you're getting a higher margin car, and what Cathie says, higher quality car made in China than you are in California's Fremont facility. That is a money play right there. That's big. Now we're going to hop back on over to CNBC here, but that was a really good statement there.
Are the classic stay-at-home plays, Teladoc, Zoom Video, Peloton, and investors have soured on them lately. Number one, because it seems like it would be as good as it gets during the pandemic, and a big pull forward in a lot of their revenue. And number two, you look at some of these earnings reactions, and you've seen some really sharp sell-offs and questions about whether they're overvalued. Why are you sticking with them?
Well, we legged into them as in this period. We had sold actually into the coronavirus because we saw these stocks soaring, and many of our others completely misunderstood. So we made some what turned out to be very good moves in terms of their relative appreciation one to the others. And we have been legging back into them in this period because they've been cut in half, most of them. So what you are saying about stay at home and the disaffection with them in the marketplace seems to be getting priced in. And we think these are platform companies. They're for the new world that are harnessing data. And we're in a period now. Many people think we're going back to the old world. I don't think so. Better, cheaper, faster, more productive, more creative we're not going back to the old world. We really, even thinking about digital work, I know at our firm, we're debating exactly what our hybrid strategy is going to be and how it's going to work. But I think Zoom is going to become essential. It is part of the enterprise software stack and technology stack. Communications is the largest part of that stack. And we think that Zoom is going to take a bigger and bigger chunk of that stack. One of the things and from our own experience, we know, Zoom's at its best inter-company. Many people say, well, what about Teams? Microsoft, this is why Slack had to sell out to Salesforce. This is different. Microsoft cannot scale, we don't believe, the inter-company communications. They're very good at intra, and we use Microsoft in-house. But inter, we think that's going to be Zoom's market, and we do think it's going to take more and more of the traditional communication stack, PBXs, for example.
What about Apple? Not a typical ARK stock, but you have owned it in a fund, and I've noticed that you've been selling it, and in fact have halved your position this week. Why?
Yes, what we do as a bull market extends, as it did last year, we usually put into the portfolio, since we cannot hold any cash, we put into the portfolio, I'll call them cash-like innovation stocks. So the FANGs certainly meet that criteria. They're acting like defensives. They truly are. On days when utilities and staples do well, very often communication services are doing well. So during a period of volatility like we've just seen, we will sell those stocks and move into either our more pure play or earlier stage innovation companies that are being hurt by the risk off.
Cathie, you grabbed some attention and news recently by buying into Twitter. Talk us quickly through the rationale, and I guess are you buying more, given that it's pulled back again of late, trading it down about 52 bucks?
Yes. So Nick Gruce is our analyst on Twitter, and he's been experimenting with Spaces, which is their version of Clubhouse. He loves it and thinks that could do very well. We also think that tipping, and this had been a rumor for a while, they announced it today, I believe, that tipping might become a bigger deal for Twitter than most people anticipate. Might be much more important to their monetization strategy. And as you know, we understand at ARK the power of Twitter. We are pushing our research out through Twitter. It is our most productive social network. It is helping our analysts engage with and become a part of the communities they are researching. There's nothing like Twitter to do that. And I think a lot more knowledge workers are going to be forced into, or lured into, onto the platform for that reason.
Cathie, away from your positions, I wanted to ask you about Bill Wang, who, as you know, has been in the news lately behind Archegos. And Bloomberg reported that he's a backer of yours. And I was just wondering what that meant and how well you know him and whether you've shared investment ideas with him.
I know Bill Wang. I met him actually through a church. We were both advisors to what was called the financial services ministry, younger people going through the financial services industry, especially in New York City. Nice. So that was in 2013. And on our way back from that event, we were exchanging stock ideas back then, and I know he bought into one of the stocks in which we had a high degree of confidence, Netflix, and he hadn't been involved at all in U.S. stocks. He had mostly been involved in Asian stocks, so he was very interested, and we chatted a bit about media generally in the United States. So yes, he did provide the seed for our first 4 ETFs, and we were very grateful to him. It was at a time where market makers were sick of seeding new strategies because they'd be stranded with $2 million stuck in an ETF that doesn't go anywhere. So we needed to go out and find that seed. And Bill, hearing what I was saying about the company that I was going to start, and I did share that with everyone at that retreat, was very intrigued, and very intrigued with the stocks we were interested in. He was just beginning to learn about them. I have not spoken to him. I sent him a note after I heard about the unfortunate events that we've all witnessed, and I'm wishing him well. But he was there for us in the early days, and we're very grateful to him.
Do you know if he still had any capital in any of your ETFs in recent months? Obviously, there'll be a lot of banks chasing any remnants of capital that's left.
Yeah, to be honest, I have no idea. As you know, with ETFs, we don't know who our shareholders are. The idea at the time was to seed. I've never asked him if he kept the money in. If he wanted to volunteer, he might have, but no, we've never had that conversation.
Well, Cathie, thank you so much for this extended conversation. As always, it's a pleasure to catch up. Cathie Wood, thank you for joining us.
Thank you, Cathie.
Right. Bye-bye.
That was really good. Okay, so I did a recap during the last commercial break on the first half of their discussion. So now I'm just going to do a brief recap here of the second half. Second half, a lot less to talk about in the second half. Talked about why Cathie is still investing in companies like Zoom. This is a big one. We've talked about on this channel many times before. It's a brilliant strategy, but Cathie Wood uses Apple as a cash park. We've talked about this, in fact, earlier in this particular video, or this particular live stream. We've talked about how Apple has been trading sideways since like August. Since the stock split, the beginning of September. And this is something that really creates this opportunity where if you got a bunch of money in Apple, it can make sense to sell like an Apple or Amazon and move that money into something that is sold off like a Peloton or an Etsy or a Roku at lower prices before it just ran up. Or Twitter. Twitter's also been selling off, and she talked about how one of her analysts really likes Spaces. I'm sure there's more analysis that went into it, but really likes Twitter Spaces, and so they're buying Twitter. And Cathie talks about the introduction of the tip jar. Now, I would have really liked to have heard a little bit more about her thoughts or her thesis around the tip jar in Twitter, because Twitter does not take a cut of tips that will go to tweets on Twitter. So if you don't take a cut, how are you going to make money? I don't know. I don't figure that out yet. I mean, maybe more users, maybe more engagement, maybe more ads because of that. That's probably the answer. In fact, I would say with 90% confidence, that's what the answer is. But anyway, she thinks that anytime you get these sell-offs and people go risk off, time to sell and dump your Apple and Amazon and dump it into the ones that have sold off, which makes sense to me. This is actually one of the reasons I like putting money into index funds when the market's zooming, so that they're little piggy banks, I call them. I call them piggy banks. When the market crashes, you break the piggy bank, you sell the stuff that's kind of like your cash park, whether that's indices or, in her case, Apple, Amazon, and you park it into your higher, smaller conviction names. Now, what we got to do together, okay? We got to do this right before the closing bell. Please help me out. Go to @RealMeKevin on Twitter. We got 2 tweets here. I'm going to read the second one first. Cathie Wood would love to host you on YouTube. We love watching and supporting ARK Invest on YouTube. Go show your support. I even tagged Gerber Kawasaki here and Kevin O'Leary and suggested, hey, maybe we even do a group interview. That would be so cool. Think about it. Hey, Kevin O'Leary and Ross and Cathie all on one. That'd be sick. That'd be amazing. So retweet this. Make this happen. We gotta get ARK's attention. I did also tweet the comment about Teslas in China, China being higher quality. This honestly is something where, if this ends up being true, why would anybody want to buy a Tesla manufactured at Fremont? California better help Tesla keep Tesla competitive at the California manufactured places. Otherwise, they're just all gonna leave California, which is obviously the theme right now, is leaving California.